everyone. Welcome to Accounting 101. Dr. Donna Barris here. Today's lecture will actually be a two-parter. So this is part one, and the reason why we have to split it into two lectures is because the topic is such a intense and intricate part of understanding accounting and also your finals and your midterm, which is in 2 weeks. So what topic am I talking about? Journal entries. Now, for most people who didn't realize that, accounting is the language of business, when they think about accounting, they think about numbers and charts and everything, and debit and credit. This is a portion of the debit and credit portion of accounting. And journal entry is such a key part of understanding accounting that I feel like, especially since we're in a virtual setting, I want to make sure that we do the due diligence and spend enough time so you can understand it. All right? So this week and next week, we'll be discussing journal entries because you can't pass my midterm or the finals and therefore the overall class if you don't understand journal entries. Okay, so I like to start by making things relatable. Does anyone know what is Newton's law of motion? Has anyone ever heard of Newton's law of motion? No? I'll give you 30 seconds to Google it. While you're Googling it, I'll actually tell you. So Newton's law of motion, Isaac Newton was a physicist. And basically his law of motion says for every action, there's an equal or opposite reaction. That in a nutshell. What does physics has to do with accounting? Probably not much, but basically what Isaac Newton was saying was for every yin, there's a yang. For every out, there is an in. For every up, there's a down. Remember in accounting, when we discussed the gap principles, principle 8 was a matching principle that basically says for every debit, there must be an equal and corresponding credit. That's why I brought up physics in the class. No more physics going on. So Newton's law of motion says for every action, there's an equal or opposite reaction. In accounting, it basically says for every debit, there must be a credit. Now, what does that mean? Step back a little bit before we get into the actual charts. So one of the ways that people can, or businesses, whether you're a large corporation or a tiny sole proprietor, keep track on what is going on, not just their memory, is actually have to put pen to paper and record and analyze and summarize what is going on financial transactions. You'd be like, that sounds so familiar, because that's the definition of accounting, a system of summarizing, analyzing, and recording financial transaction. Today, we're going to discuss the recording portion of it. How do you write it down? If you own a business, or even if you're doing a budget, but we want to focus on business, whenever you buy something, right, you want to record that on this date I bought something for X amount of money. And whenever you sold something, you want to record on this date I sold something. No different than if you were having a personal budget. You would say, oh, on this day I got a paycheck, or on this day I got an allowance, or this day I got some money, and on this day I spent some money, on this day I saved some money. It's just the portion of recording what is going on in your life. And that, in a layman term, is what is journal entries. So basically journal entries are recording financial transactions of a business. All right, so accounting is a process of summarizing, analyzing, and recording financial transactions. Journal entry is the recording portion of it, meaning that you have to write it down. So when you're writing it down, though, you have to say, okay, do I just list it? Some people just list it in regards to, okay, this is what happened, this is what happened, this is what happened, this is what happened. I bought something, I sold something, I got something, I threw away something, I lost something. All of those are actions and transactions or things that will impact your overall money. right? But before we get whether we made up, is this a positive or negative thing on us, we need to discuss, wait, where does it go, right? So if I received the money, what do you think that is going to do to my bottom line? And my bottom line meaning my profit or my bank account, right? If I've got money, what does that mean? My bank account is happy because that is a positive intake to my overall bottom line. What happens if I have to buy something? That means money's walking out of the door, right? So both are transactions, but each one of them have a different impact on my overall bottom line. And that's where the journal entry portion of it is. So we've recorded it, all the transactions that happen. I've gotten money, I've spent money, I've lost money, I found money, I threw away money. All of that are the actual transactions that are going on. Now for the journal entry portion, we want to put basically all the things that makes my bank account go happy. We put it on one side, and the things that make my bank account go, we want to put it on the next side, right? So that in a nutshell, in a really basic, fundamental way, is what we're going to discuss today. So, as I've mentioned now, in the matching principle, for every debit, there must be a corresponding and matching credit. So what is debit? What is a debit? So most bookkeepers or people that are keeping track of what is going on with the money like to have a standard or a format in how what is going on, whether money is walking out or money is coming in. And that's what we mean by debit and credit. So the actual definition of debit is, get your pens and paper and let's discuss what are debits and what are credits. So here's the thing, debits and credits occur simultaneously during every and any transactions. As we just mentioned, remember yins and yans. Now the debit side is the left-hand side of, most people like the T account. So it can look like this, T account. So the debit is the left-hand side. We just put for DR of the T account, and all expenses, when expenses increase, it goes on the debit side, and also when assets increase, it goes on the debit side. Simultaneously, credit, which is abbreviated as CR, which is on the right-hand side of the T account, when revenues go up, when liabilities go up, or when equity goes up, it falls on the credit side. That sounds like a lot of things to remember, and you're saying, wait, what, Dr. Boris? So don't panic, even though all what I just said sound like mumbo jumbo. That's why I'm here. What you want to remember, even if you don't remember anything else with journal entry, brainwash yourself with this. Are you ready? You're always going to debit the receiver, credit the giver. No matter what anybody else says to you, when it comes on to journal entry, debit the receiver, credit the giver. So in whatever situation that you are in when it comes on to journal entry, the first thing you want to try and find out, what is the receiver, who or what is the receiver, and who or what is the giver, and it helps you to actually know which hand it falls under, right? So I know we've been throwing out certain things in regards to assets and liabilities and equities, and that sounds similar when we had discussed the different types of financial statements, and one of them being the balance sheet. And I said to you way back when that the balance sheet, which gives you a snapshot of the overall health of the organization, also have the accounting equation on it, which is asset is equal to liability plus owner's equity, right? So what are assets? So we discussed assets are things that we own. So assets are mine. And some examples of assets, which can be either tangible or intangible, meaning things that you can physically see or things that you can't see. And you have current assets and long-term assets, but examples of things that we own. Give me an example of things that you own that are mine. The cash in my wallet, that's mine. That's actually an asset. Now that would be current asset because it's quick. It's something that you can turn over and use to pay for something that you owe, which I'm jumping into the liability portion of it in a second. But assets are things that we own, be it tangible or intangible. It can be current or it can be long term. Another example of assets could be, what your car. It can be any supplies or inventory that is mine. So basically anything that you own. Now, in terms of an example of a long-term asset, so think about something that you own, but it's long-term, meaning that it's not easily turned around to pay or to cover something that you owe. Your land, because it's not like if somebody comes to you and be like, yeah, you don't have any money, you need to give me my money now. You can't just sell your house that quickly. So your home can be a long-term asset because it's something that you own for the most part, but it's hard for you to turn it over quickly to cover debts. What are other long-term assets? Equipment. So anything that you own that is yours, those are assets. And what you need to remember is they can be tangible or intangible. You're saying, I don't understand something that would be intangible. I'll give you an example. Michael Jordan, right? If you just see this, that tick, I can't draw, right? Immediately you know that's Nike, right? That's Nike's brand. Do you think that you can just start a brand and put a tick on it? No, a brand is a company's asset that's intangible. Right, and when we get to copyright and patent and branding, we could discuss it further. But an example of an intangible asset would be somebody's brand, somebody's reputation. Yes, that's an asset. Yes, your reputation is a cornerstone of your power. So if somebody know you, your employee know you as somebody that shows up on time, you might think that that is not an asset, but yes it is. They're saying, listen, I'm going to put Susie to open because I can set my watch on Susie. She shows up on time. That is an asset. That's something that you own. That's something that generates funds for you because someone, based on your reputation and your past performance, somebody can say that, you know what, that Susie girl, she's a good employee because she's always on time. So your reputation could be an intangible asset, right? So assets are things that you own, be it tangible, intangible, or current or long-term. Now a liability, on the other hand, is things that you owe, meaning that you're indebted to someone else. So like assets, liabilities can be either current or they can be long-term. Now, what are things that you owe to someone? If I owe them money, right? So notes payable. If I owe taxes to Uncle Sam, so that's taxes payable. If I am an employer and my employees work and they are supposed to get their pay and I haven't paid them as yet, so that is wages payable from my end. If I have interest payable, so if I took out a loan or something, your student loans, those are some, and you see those interest payables. Anything that you owe to someone else is a liability for you. Now you have current liabilities, which are usually things that are due in the next 30 to 90 days. And then you have long-term liabilities, which are due at a longer term. So, what are examples of longer term liability or long-term liabilities? Like bonds payable, notes payable, like the maturity of your overall mortgage, the actual principal on your student loans. So things that aren't coming to due right now. Does that make sense? And as we've mentioned, once you take your asset and you back out your liabilities, that give you your overall equity, meaning that once you've taken what you've owned and pay out what you owe, what is left over, basically your worth, is what your overall equity on it, right? So I wanted to give you examples of that. So we have covered the accounting equation, we've discussed debits and credits, and we've already said that with journal entry, which is a recording of financial transactions, debit and credit actually happen simultaneously because of Newton's laws of power. I am good. I'm able to sit here and just tie it all in. Ooh, that is an asset for me. That is an intangible asset. Yes, I'm fierce. So, because of Newton's laws of power, or the 8 matching principle that says for every yin there's a yang, debits and credits happens at the same time. So I'll give you an example of a transaction and see that there's two. It's a two-parter, right? Let's say I want to start a business, right? Let's say I want to start a business. Should I give you that example? Yeah, let's try. So let's say we want to start a business, and the name of my business is, I don't know, Dr. D's. Wait, didn't we have a bakery? Yes, we were starting our bakery way back when. Let's start our bakery. So we're going to start our bakery, right? And we're going to be a LLC, because remember, I don't want to be a sole proprietor. Child, no, because in the eyes of the law, the owner and the business is the same entity, and you are not coming in my business, and you're not going to slip and fall and try and take all of my money. Nope. And for a partnership, I'm not trying, because I can't cook, and the person that was cooking might be having a bad day and somebody have an allergic reaction. So I'm going to do an LLC. And a limited liability company one is just a limited where I am only responsible for a limited amount of liabilities. So it can still stay fabulous even if you sue me, right? So let's open a business, yes. And I'm opening Dr. D's Bakery, but it's an LLC. All right? Now, before I opened my business, I am going to try and gather all my coins. So I am going to move out, let's say $10,000 from my personal account, right, to start the business. So from the business's point of view, I'm going from the business's point of view. It doesn't matter where I got the money. Let's say it doesn't matter where I got the money, because I don't want to confuse you. Let's say I'm starting the business with $10,000, right, that I deposit into the business account on January 1. So journal entries normally are recorded in chronological order, meaning as they happen in the order of dates. That's what we put down. So as it happens, we put it down. So let's say we're starting our business January 1, and we invested $10,000 into the business account, right? So the first thing you want to always put is the date. The date is important, because when the SEC, I told you everything that I tell you ties in. So if the SEC wants to come in as the police to be like, spot check, let me see all your statements, the first thing they want to see is the date. So when did this happen? So you have to always put dates on your financial transactions, and even your internal recording, you have to put dates on it. So dates are important in accounting. So on January 1, so debit the receiver from the business point of view. So this is Dr. Burris's Bakery LLC. What happened? What came in? What did the business receive? receive money. Bank. So I'm going to debit the receiver, which would be bank, and credit the giver. So what would be on the credit side? That's actually capital in my business, right? So you would put like capital, right? $10,000, right? So even this one might seem a little bit, oh, I don't understand this one so well, Dr. Burris, but just let's keep on going so we can follow a little bit more. Let's say on January 2nd, since it's an LLC, I wanted to pay the registration fee, right? The business now is paying the registration fee of $950, $900, $1,000, whatever it is. Let's say we're using $950 registration fee. The business, so we're registering the business. Now, what is coming in? Like, nothing is coming in, but what is going out? Money is coming out of my bank because I am paying somebody for the registration fee. So that is an expense, right? So we know what's going out. So we know we credit the giver, who is giving, the bank. So we know for a fact bank is here because money's walking out, right? And we said how much it was? Let's say $900, right? So what is going on the credit side? You can't leave it blank because Newton law and the matching principle says for every debit there must be a credit, for every credit there must be a debit. So therefore, what would be on this side is the expense, right? We said we're paying a registration fee, so it's an expense. So it would be registration expense, let's say $900, right? Does that make sense? Let's give you another example. Let's say on January 3rd, we rent office space, right? We rent office space for $1,000 and we had to pay up front. So we rent office space for $1,000 monthly and we had to pay up front. So on January 3rd, is money coming in or money going out? January 3rd, we rent office space for $1,000 payable day one, right? So we hear that money is walking out of the door once we start rent. So money is walking out. So since I didn't tell you whether it's bank, it can be bank or cash, all right? And in the midterm and in the finals, I'll be very specific on it. So what would be on the debit side? Rent expense, right? Does that make sense? Rent expense. So let's say now, on January 4th, we hired an employee and she is going to be paid every 2 weeks a salary of $500. So on January 4th, we hired an employee and she's going to be paid every 2 weeks for $500 for every 2 weeks, right? Yeah, but I didn't pay her. Did I pay her on the 4th? No, all I did was hire her. Did anything go out? Was there any receiver or giver? No. So that's informational. So that is what you would call a no entry. Right? So you have to listen to it. I said I hired an employee on January 4th to be paid every 2 weeks $500, right? Am I giving her a check the first that she walked in my store? I interviewed her. I say, you're hired. Am I giving her a check on January 4th? No, dear, it doesn't work like that. So that is just a no entry on my part, right? Now let's say January 5th, we have to pay the utility company $500 cash to set up, to turn on all the lights and the gas and everything. Jesus, I'm paying everything. Ooh, starting a business is expensive. Yes, it is. So On January 5th, I am paying, so that's just money coming out, 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 money's walking out. So I said I'm paying the utility company $500 cash, right? To set up. So it's utility expense, $500, right? Jesus, when I'm gonna start earning money? Yikes. All right, let's say January 7th, you had a sale. Yay, money! You had a sale of $200 cash, right? Yay, money. You had a sale of $200 cash. A customer purchased product for $200 cash. So January 7th, what am I receiving? Finally, cash, $200. And what would be over here? It could be service rendered or revenue. Service revenue. Because remember when I told you that credit you and it would be $200. All right? So those would be how the journal entries would look. The main thing, the date, as you can tell, it's in chronological order. For every debit, there must be a corresponding credit. For every credit, there must be a corresponding debit. But the main thing you want to do is debit the receiver, credit the giver. All right? And once you look at it that way, you should be able to get a deeper understanding of it. I am going to recommend you guys watch this video multiple times. Try and think of journal entries that you can do. Next week's lecture will also be journal entries. I'm going to try and see after you've done some more on your own. You're going to come back a little bit more seasoned, and we're going to work on it again. And what is also important that or online discussion, I am going to open up the online discussion for 2 weeks. So you're going to just get basically one assignment, but it's going to span 2 weeks, because I want you to make sure you're understanding it, and I don't want you to be bombarded down with extra work, because this is so important. So you are going to do the due diligence of doing independent work. Next week's lecture will also be more journal entries, and also your online discussion for this week will be opened for 2 weeks. Still try and do your first post by day 4, but I will open it up for 2 weeks, and it will be focused on journal entries. All right, thank you guys very much. If there's any questions or concerns, feel free as always to reach out via email and or Blackboard. All right, thank you. Bye-bye. Happy researching journal entries.